Hey, everybody. This week, Dave and I talk about what we do with some of our cash value. A lot of people have been asking, hey, I've got these policies. What do I do now? So we kind of answered this question this week on what we do with some of our cash value. And one of the things that we do with it, we do some note investing. So if you want to find out what that is, stay tuned, watch the webinar. We had a great time. Hope you enjoy. Thanks.
Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast. Hey, today we're going to talk about something that it's a question that comes up all the time with me and Paul. Because as you get into infinite banking, as Nelson says, when you have capital, opportunity will find you. Well, the next question people have is once they have capital through their cash value is where's the opportunity? And where should I be looking? How do I vet these opportunities? What's the best opportunities out there? And so Paul and I get a lot of questions about, hey, what do you guys do? So what we'd like to do today is show you exactly one thing that we've both done with our cash value, our capital, and put that to work. So we will, that's what we'll dive into. And let's see, I think we might as well go ahead and get started. Paul, you got anything to open up with here?
Yeah, just, small disclaimer. We're not your banker. We're not your investment advisor. We are not investment advisors. This is not investment advice. This is just an example because, again, like Dave said, everybody asks, hey, what are you doing? Well, this is what I'm doing. But I'm also doing this. I'm funding the build of this ridiculous pool, which it'd be great if it was still like 1985 prices, but it's not. So, but this is just an example of, I think, people, they don't realize, early on in their IBC journey, like, yes, a policy loan repayment it shouldn't be thought of like your car payment or your mortgage where, you send that payment in, that money's gone, right? It should be thought of as kind of, I look at it as kind of putting money back in my savings account in a sense, right? Because it's available to me again when I make that payment. So anyway, disclaimer out of the way, Dave, fire away, bro.
All right, and if you guys have any questions while we're going through this, go ahead and throw them out there. You can interrupt me and ask your questions. If there's anything in the chat, Paul, that you see, go ahead and bring it up.
I got you.
Because we can pause as we go through this. But I'm going to go through at a high level, show you one thing we've done. And, if you ask questions that are kind of beyond the scope of what we're talking about here, I'll let you know, and we'll catch those offline. We can direct you to more information on this particular opportunity if you're interested. So I'm going to have my iPad, share my iPad screen now. I'm going to pull up my whiteboard here. Good morning, Rebecca.
Good morning.
Okay. So first off, when it comes to what Paul and I do with our capital, there's a lot of criteria that we evaluate. But if you want to boil it down to say maybe the three big things when we're evaluating an opportunity, it's, what's the risk? We're looking for the least amount of risk possible. We want a proven model that's got, zero risk if possible. Number two is I want something consistent. I want to be able to plan on it, especially if I'm going to use my cash value loans to put it into an opportunity. I want to know what my repayment plan is because we don't want to steal the peas, right? We want to have a repayment plan for all the loans we ever take. So is this a plan that's going to pay me monthly and I can use those proceeds to repay my loan monthly? Let me get rid of that. Or is it just a balloon payment at the very end of the note and I need a plan for that? But it needs to be consistent, something I can plan on. And three, going back to number two, I need to have a way to pay off my loan. So whether that's I'm able to pay my loan from my normal cash flow because it's increased and I've got the ability to do so, or this opportunity is going to help repay my loan as I go. But one way or another, you got to have a way to repay that. Anything else to add to that criteria, Paul?
No, I think that's spot on. Like we talked about before when we were talking earlier, I think there's two cash flows always, folks, right? Um, you have to have your dedicated premium cash flow. And I don't want to get into base or PUA, but your premium is X. You don't want to have dedicated cash flow that is for that. But also, when you leverage your policy, you also have to make provisions for loan repayment. So that's a different cash flow. Some people could try to get too aggressive early on, and they'll want to pay X premium, and I'm like, hey, what are you going to do if you take a loan? Like, how are you going to repay that? Because it looks like you're right up to the limit of your monthly or annual cash flow. So just keep that in mind as we go through this. You're going to create, in the example Dave's going to outline here, you're going to create a cash flow, right? And we're going to talk about different things you can do with said cash flow and any other cash flow that you might have already.
And remember, it's all one pool of capital. So where you put your money for that opportunity doesn't necessarily have to be the only place that the cash comes from to repay your loan, right? Any money coming into your life can be used to repay a loan, and it should be. So let's start with this. So what we're going to outline here is this opportunity is really, you could call it a note investing. So we put money into another pile with a bunch of other people, and that money is used to loan to another business entity and create a note. So really what we're holding in this opportunity is a note, just like the bank holds a mortgage on your house and you pay monthly payments, amortized payments back to the bank every month, and the bank gets to hold that note as collateral. That's what we're holding here. So how that happens is, let's say, let's just use an example of $10,000, just a round number. So if you want to participate in this, you're going to take $10,000, and in this case, let's say it's from your policy, so a cash value loan. You're going to take a loan against your cash value for $10K. And you're going to put this into this circle here where a lot of other people are putting, 10,000, 20,000, 200,000 into this. Now, when this amount is filled up, this entity is going to loan the money to this business partner over here. So all of that is going to come over here, and in return, we get to hold a note. Also, the way these notes, in general, this opportunity right here, when Paul and I participated, and they could change, they're subject to change, but they happen every couple months, is 9.5% amortized over 5 years. So a $10,000 note earning 9.5% amortized over 5 years is actually going to return $210 per month. So you're going to get $210 for the next 60 months. And that's principal and interest. Right? So that's going to come back to this group every month. And then they're going to pay me out $210 per month for the next 60 months. So that's coming to me that I can just throw back into my policy to repay that loan. So if you do the math, after 48 months, I've received $10,000. So I've covered the full loan amount. And now I have 12 more months remaining in the 60-month note. So in the next 12 months, that's the interest. If I borrowed against my cash value, that's going to cover the interest I owe on my loan, plus my profit. All right, so this one covers all three of my criteria, which is as little risk as possible, because the entity we're lending to, this business right here, is a business partner that we've had in our group for over 5 years. And our money is secured by millions of dollars of free and clear real estate. So I'm not worried about that loan coming back to me. about that being paid back to me. It's a proven model. It's been there for a long time. I'm not saying there's zero risk whatsoever. I'm just saying this is about as low risk as I've found from my own capital. So this is option one. Let's call this option one, where you simply use the proceeds from that opportunity, that investment, to repay your loan. So at the end of 60 months, you're going to have your loan repaid. You're going to have the interest that you owe the insurance company paid off, and you're going to have some profit. All right. I'm not going to get into the details of what the exact numbers are on all that, but you will have something, right? Because you're earning 9.5%. You're paying, say, the insurance company 6% annually. All right, so that's option number one. Is everybody following me so far? If you're not, go ahead and let me know where you got tripped up. Okay. So let's go to option two, where let's say we use our cash flow plus the amortized payment to pay off that loan. Now, this was where it actually gets pretty exciting. So let's say you did the exact same note, $10,000, you're receiving $210 per month. But let's say you're able to free up another $500 a month in cash flow. And your regular income. And this may come from, maybe you're saving money somewhere else, right? In a different pot, like for your escrow, for your tax bill that's coming up. If you're a business owner, maybe you're saving it to pay your kids' tuition, college savings, whatever that may be. Well, it's all one pool of capital, right? So you could actually grab some of that and use that to help repay this loan quicker. Because as we know, if you do infinite banking, you know every dollar you pay back towards that loan becomes a dollar available for you to access again within a very short period of time, right? So let's say you dug up $500 a month that you could put towards repaying your loan faster. So you got $500 in cash flow and you got $210 coming from this investment. That's $710 per month. Well, if we take your $10,000 divided by 710, you're going to have this note paid back, or this loan paid back in 14 months. Much quicker, right? And I'll tell you the truth. This is the way most people, if you've never taken a cash value loan, this is what most people realize is, wow, I can pay this back a lot quicker than I thought. Because it almost becomes a game. You can gamify it like, hey, how quickly can I repay this? It's one of those loans that's fun to repay because you don't lose access to it. When you repay a bank loan, as soon as you pay them back, you no longer have access to that money. Unless it's a line of credit. Well, with your life insurance loans, you have access to it within usually a couple weeks?
About 2 weeks.
Yeah. So you can pull it right back out again if you need. So you've paid this back in 14 months. Now you've got $210 coming back to you that you need somewhere to put it. Well, what a lot of people do in this situation is they'll create a second $10,000 note. They'll just recycle that $10,000 and do the whole thing over again. So let's say you do a second note of $10,000. You loan $10,000 to this company and you start the whole thing all over again. Well, now you've still got your $500 a month in cash flow. You've got your $210 from the first note, and now you've got $210 from note 2, which equals $920 per month that you can use to repay your loan. So now if you take your $10,000 loan divided by $920 per month, you're going to have this paid off in 11 months. Everybody following me so far?
On that
All right.
second one, do you have to wait the 14 months before you can start that second note?
Yeah, in this example, Rajiv, that's exactly what you do. You've repaid. You don't have to, right? Maybe you repay and you do a $5,000 note because you can do smaller than 10,000. But let's just say you wait until you repaid that entire 10,000, and now your plan is just to recycle that same 10,000 as many times as you can. So that's what this example is showing.
And I also think in this offering too, Dave, right? There's roughly what, one note per month that's available?
I think it's
in this-
about every other month.
Every other month? Okay. So 6 notes. There's 6 notes a year.
Okay, so now you're 25 months in, and you've got 2 notes going, and you've repaid those $10,000 loans twice. So now you're going to do a third note. You still use your $500 in cash flow, and now you're doing 3 notes at $210 per month. Equals $1,130 per month that you can use to repay your note. So now you got 10K divided by 1,130. That's 9 months. So now you've repaid that third $10,000 loan in a 9-month span. So you can see every time you do this, it gets shorter and shorter and shorter. And now you're what? 25 plus 9, you're 34 months in. So you can see this is what a lot of people do. And this program actually kind of shows you that the snowball you can really create by doing this. So then you just keep recycling that. I'm not going to go through, up to 6 notes worth, but I think at some point you'll have probably 6 notes going at the same time. So you're receiving like 6 times $210 per month. So you can start repaying these notes very quickly.
Right.
And just go indefinitely. So that's the strategy that a lot of people actually partake in when they understand this model. Some people may call it like the income snowball model or something like that.
So would an analogy be like a CD ladder?
So a CD ladder. So explain that to me, Chet.
Well, this is like my parents do and have done, is they go to their bank, they do a CD for 1 year, and then it's just as they mature, it just recycles. I mean, it's just that very conservative way of doing it.
Yeah, right. They're recycling the bigger amount when that CD matures. Now they've
Right,
got
they're
a
compounding
bigger
on
amount,
an annual basis.
and they put it into another one. Yeah, they're just recycling, compounding that annually. This is just you're able to do this at your own speed and quicker, as quick as you want.
Yeah.
Yep. All right. Now let's go to. I came up with a third option because here's where a lot of people end up or start out. So let's say in this option, you're either wanting to start your first policy, and a lot of people who come to me and Paul and they want to start their first IBC style policy because they learned about infinite banking and they're like, wow, this is what I want. Well, most of them are pretty good savers in the first place. So likely they've saved up a lot of money somewhere else, just in the wrong place, in somebody else's bank, right? So they've got a big lump sum that they can do something with. Well, you could, like Paul and I help people do, is fit all of that into a policy right away. But another option, something I've seen actually from a client, I've done this myself, but a client did this as well, where they'll take that big chunk and they'll put it into this note program first and use those amortized payments as a monthly premium payment for the next 5 years. And then they're kind of hands off. So let me show you what that looks like. I would say windfall or savings. And I'll give you an exact example of what one client did. In fact, this is the oldest client I've ever put a policy on. He's 70 years old. But he understood. His wife already had a whole life policy. She had been working with me, and now he wanted one. And they said, well, we've got the $70,000 that we just came into. What's the most productive use of that? And how do we ensure that I can fund this policy for the next 5 years? Because I don't necessarily have the cash flow to do that. I could put all this money in the policy in year 1, but year 2, now I'm kind of strapped. So we looked at this opportunity, which he knew about already. And we said, well, why don't we put that 70K into the note program? And if you do your little amortization calculator, what that equals on a monthly amortized payment coming back to you for 60 months is $1,470 per month for 5 years. I'll just say for 60 months. So what we did is design a policy for him to be paid monthly for precisely $1,470 on a monthly basis. So that's a pretty good size. That's like what, over 16,000, close to, I think that's close to 18,000. Multiply that by 12. You're close to $18,000 a year in a premium.
Yeah, 17,641.
Right. So not bad. Right. And he's hands off for the next 5 years.
Hey, David, can I ask a quick question?
Yeah, go ahead.
This is somewhere where I'm sort of getting tripped up. So you've got your 70,000. And from listening to you guys and also talking to Travis, I mean, when you are making those deposits into your IBC, it is sort of sitting stagnant. So are you able to open up this 70,000 policy, but not pay it till the end of the year, and that's how you're funding the note with that 70,000? Or it has to funnel, you have to put it into the IBC first?
Well,
That's where I get tripped up.
There's two ways to do it. You could use that 70,000 to fund a policy and then borrow out a chunk to put into this program and use the amortized payments coming back to repay that loan. Right?
Got it. Okay.
But then you need to pay your premium out of pocket, and you need to repay that loan with those amortized payments. In this client's particular situation, he didn't want to have to pay that premium out of pocket. He's in retirement. He's kind of living off what he's built up his whole life, and they're kind of budgeted to, he takes in what he needs and no more. So in this, it made more sense for him to take that 70, put it into the note program first, and use that amortized payment to fund the loan. I mean, to fund the policy premium.
Right.
Got it.
Yeah.
Okay.
So it's kind of, we say sequence your capital. It's all about the sequence of your capital. Either way works fine, depending on your situation. But
Now, is there a tax implication on that? If it's not in the policy, would there be a tax implication? So that $18,000 a year is not free and clear.
No, it's taxable, but
Well, not all of it though, right? Just
Not
the
all of
interest
it.
on it.
right.
Right.
It's
Yeah,
an
so-
amortized payment. So I've got it
Yeah.
pulled up, Dave. Let me just spit
Yeah,
out
if
some
you got it
numbers
pulled
here.
up, use your little amortization calculator.
So out of the over 5 years, the total payments I'm showing is about 88,000. Of that, 18,000 is interest.
Okay.
So that means, the rest of that would be principal, return of principal.
Okay.
Yeah.
Okay.
And, that's going to be heavier interest in the beginning, and that interest gets smaller over time.
Right.
So your biggest taxable income portion of that is going to be in year one, and then it goes down every single year.
Correct. That's right.
Yeah, keep that in mind. But what he effectively did, this client did, was took $70,000 and created $88,000 of premium out of it.
Right.
That's a
Yeah,
pretty
that's
nice,
cool.
Yeah, over 5 years. That's pretty cool. And he's hands off. He doesn't have to worry about making that premium payment because, this payment comes in, call it on the 25th of the month, and then it goes back out to the insurance company on the 28th. And it's automatic. And that's exactly what I do with mine.
Yeah.
Yeah.
It's not unlike, you've heard us on the episode talk about the premium deposit fund that some of these companies have, where you put in a large chunk of money all up front to the company, and you prepay a set premium for 3 years up all the way up to 10 years. And it basically creates, so if you did like $100,000, it might create 120 something or $130,000 of premium over that decade. Right. So it's a different way to do that, just outside, separate from the insurance company.
Got it.
Yes. Jolie asked a question and Wes just answered it. Yes. So the guy is paying the premium monthly instead of annually. Yes. Yes, he is. That's exactly right.
Yep.
Which is just fine.
Which is just
if you have to, just fine. I would say I don't know what percentage of people pay monthly, but it's probably half at least.
It's whatever suits you. I mean, I pay most of my policies annually, but I do have one that's set up for monthly and will be for 5 years.
And
I'll
so
show
that
you-
that other half is you're putting it in the money market, or something that where it's not just sitting in your policy stagnant, right?
What other half are you talking about?
Well, you said half are paying monthly, and the other half
No,
are
half.
paying.
Half of the.
Oh, I just mean
yeah.
over our clients.
Yeah.
Oh, okay.
Yeah,
Okay.
some there's 4 modes of premium. There's monthly, there's quarterly, there's twice a year, and there's annually. I would say out of that group, it might be almost a 50-50 split between monthly and annually.
Okay.
Just
Okay.
unofficial.
All right, my bad. Sorry.
Yeah.
Yeah, no worries. No, great question. Ask away, guys. We want, part of IBC is we want client clarity.
So let me give you another example of what I did. So this is for somebody who maybe doesn't have a policy yet, but they have a big chunk of cash that they want to turn it into premium. This is a great way to do it. Now, what I did is how about what if you already have cash value? So Paul and I have done a couple episodes on when is it the right time to start a new policy. So if you want to dive into that, go back and we'll give you the episode numbers to listen to. But there's plenty of ways to decide. One of the easiest ways to decide is that, hey, I'm funding my premiums, no problem. I've either repaid all my loans or I'm not taking loans because I'm just capitalizing myself. Or the loans I do have, I've got a way to pay them back already, and I've still got additional cash flow I can put into starting a new policy. Well, there's 2 ways you can go about doing that with using this program. One is you just use that cash flow to start a new policy, right? You create a new monthly premium that you're going to pay in a policy and start capitalizing another policy, and there's nothing wrong with that at all. That's ideal. Or you could, if you have cash value already available, you could take a loan against your cash value, put it into this program, and then use the monthly amortized payment coming back to you to fund that new premium. So you're basically doing what this client up here did, this example, but you're just doing it with your own cash value. So let's look at what does that look like? Paul, you want to give me numbers? Let's just say it's let's use a bigger number because you want to create a more meaningful premium. 50,000 or 100,000 of cash value.
Oh, I was going to say like 200, but whatever.
Okay. Well, let's say you
Or
got
maybe just
200.
do 100 because it's easy.
There's round numbers. Okay. Will you do the amortized payment for me?
Sure.
Actually, you know what? Yeah. Well, anyway, cash value loan of 100K.
Got it.
That equals what kind of payment per month?
2,100.
So I'm getting 2,100 per month.
Mm-hmm.
That's
And
gonna
I
go,
use 9.5%, 5 years.
Yep.
Okay.
Now we didn't mention there's also semi-annual bonuses. Like every 6 months, there's a bonus on best effort. So it's not guaranteed, but
Potential, yeah.
there's potential bonuses every 6 months with this too. And I actually got a bonus at the 6, maybe it was like the 7-month mark. That wasn't even calculated into this. So that's just extra juice I can just throw back in and repay it quicker. But anyway, so let's say I took a cash value loan of 100K. I put it in this program. Now I got 2,100 per month coming in. I'm going to use that 2,100 per month now to start a new policy. So that's a $25,000 a year policy right there. So I just created a 25K per year policy that's going to be funded now for the next 5 years. I'm hands off for the first 5 years. But I've got a $100,000 loan repayment. Well, but I already said I've got the increased cash flow to fund a new premium anyway. So now instead of using that for premium, I'm going to use that for loan repayment. Cash flow goes to repaying the 100K. And I'll tell you again, you're going to repay that a lot quicker than you think, because now you're repaying a loan. So like we said, every dollar you repay becomes a dollar available again. So what does that mean? Well, maybe you can go above and beyond what you were going to do anyway for that monthly premium that you're going to pay out of pocket that you're going to use to repay this loan. Now you can grab, say, those other expenses that you were saving, like we've already mentioned, like you're escrowing your property. You're saving up for your tax bill on a quarterly or annual basis. Whatever it may be, your vacation fund. Now you can take all of that excess and apply it towards repaying that loan as quickly as possible. Because guess what? It's all going to be there for you when you need it.
Yeah, I think that's so important, Dave, to reiterate. Like we've had clients in the past that have been stacking cash like in a savings account and they had an outstanding loan. And I think it was this example I'm thinking of was your client and you were like, "Why are you doing that?"
Yeah, what
Like,
are you doing, man?
pay off your and actually no. I'm not going to drop a dime on her, but it's someone you know and I know very well. She's my client and she was doing the same thing and I was like, "No, like that money should reside in your policy, right? Like pay it back."
100%. Yeah.
So that's really how this works at a high level is that once, if you can put two and two together, there's that fly. You should be directing all those excess cash flows, tuition, tithing, whatever, back toward that loan. And then
Yep.
come tuition time, you pull a policy loan, pay the tuition. Vacation time, right?
Yeah.
Go back to what episode 185, the other webinar we did.
No,
What number was
I'll
that?
look
I'm
it
probably
up.
way up.
I thought it was
But anyway.
193.
193. That's going to make you as efficient as possible. Now, if there's, I suppose,
Episode 186.
186. Oh, that's close. I suppose if you could earn, 20% of your money outside the policy, then of course you just continue to do that. But in this sense, you're not going to do that, at least not in a guaranteed manner. So pay back those loans using your other cash flows, other things you're saving for.
And so I set this up to, this is exactly what I did. So not with a different amount than this, but that amount that's coming back, I said, hey, I'm just going to start. I wanted to start a new policy anyway. Now I can actually start it a little quicker because I don't need to make sure I come up with, in this example, this $2,100 per month. That's going to be funded for me. All I need to do is repay that loan, and I can do that on my own schedule. So if one month I can't make a loan repayment, it doesn't change my lifestyle at all. I just wait till the next month and I repay a loan as I can, when I can.
Dave, in this example, is your starting point a cash value policy that you're taking a loan from? I'm a little bit confused on your
Yes, yeah,
starting point here.
exactly. This starting point is for somebody who has cash value available in their policy.
And then I'll follow in on that. So the 100,000 comes out of the cash value of policy A, but you're using the premiums from this pool of money to start a new policy B. So that one is the one that is self-sustained, but you're still, as the individual, required to pay back your policy A initial 100K loan.
Yeah, I think required is the wrong word to use because you're not required, but
Oh,
you need
okay.
to, right? To do this
Should.
process, to play honest banker, yes, you need to be repaying that loan, but you get to repay that however you see fit. You got more money one month, you can put a big chunk in. You have no money the next month to repay it, you don't do it.
Yep. Jolene's got a couple of questions. And I think we just answered it, but you still need to pay that cash value loan back from policy A. Correct. We just explained that. Absolutely. And you should. But there's no repayment schedule, right? There's no defined, like your car payment or your mortgage or your credit card, right? That you have to pay every month. You're going to pay this back on your schedule, right? And then her second question was, is there a waiting period between opening new policies? Not really. A lot of the companies will have a waiting period after you open up a convertible term policy, which you should, so that when it comes to open up policy B, policy C, policy D, and beyond on your life, let's say, that it's an easy process because the underwriting for financial and medical has already been done. That being said, not really. If you, let's say you were recently underwritten for a policy last month, we got it in force, you paid the initial annual premium, and that policy's rocking and rolling. And then your long lost Uncle Dave dies and leaves you $1 million, right? You didn't even know this guy existed. And then somehow you get a call from the attorney and you get $1 million. And you call up, hey, what do I do? The underwriting is still fresh, assuming we did maximum amount of underwriting for you, which we always do during your initial underwriting. We'll underwrite you for as much as of your human life value as possible. It'll be easy to open up policy B in that case if the underwriting were fresh.
Yeah, usually inside of a year. Certainly 6 months. Usually inside of a year, your medical exam labs are still good to go. As long as there hasn't been any change in your health, you may not even need to do labs again.
Yeah, I think they'll allow labs up to 12 months. So, yeah.
Yep.
And in this example, just to clarify, the 2,100 per month was the cash flow that was being used to pay off the loan, which now is basically paid off by the 100K. So you're using that 2,100 part of that to pay off policy A.
No, this 2,100 is your amortized payment coming back from that 100K investment in the note. So you took a loan for 100K, you put that into the note, and you're receiving 2,100 a month. You're going to use that 2,100 a month to now fund policy B, a brand new policy. Or if you wanted, maybe you use $1,000 a month to fund policy B and $1,100 a month to repay policy A. Yep. You can do whatever you want.
That'd be okay too.
Yeah.
So there's not a point where it becomes unproductive. So, I mean, in the back of your head, you're thinking, okay, somewhere down the line, I know I'm going to have cash to pay back this 100K, but is there a certain time frame to where it makes sense to, hey, I'm just going to put this back in my 100K? Because all these other examples, I talked to Travis and his goal is like every, I think, 4 to 5 months, he wants that note to be paid off.
So I would say, go back to what I said at the beginning of this particular example is you're able to start a second policy. You've got cash value in one policy, and now you've got enough cash flow coming in because your income has gone up, expenses gone down, whatever, that you're like, okay, I'm ready to start a new policy.
Okay.
Well, now you have options. You could do it one of two ways. I mean, you could probably do it many ways. You could use that cash flow to fund a policy directly, or use that cash flow to repay a loan that you took from this policy that is investing in the note to create a new policy.
Right.
It's a choose your own adventure. Like we always say, the banker can do whatever he wants.
Yeah.
And this is one more question. Sorry to keep holding you up, but this is
go.
maybe after that certain point of, I think it's 4 years that you've got to, this is, I mean, a well-established policy. This isn't one I just opened up. I funded it. I have $40,000 of cash value, but I know over those next 4 or 5 years, I've got to make those payments. So like, just to clarify, this is maybe one that's been in place for 7 years.
It could be, Riley, it could be a policy that's 7 years old. It could be a policy that's 6 months old because you funded it with a windfall because you sold a couple of properties and you needed a location to put that capital. So we designed a policy for max liquidity for you on policy A, right? And stuck a bunch of paid up additions into it and then set your, monthly or annual premium on top of that as something that was meaningful and manageable for you. And you took it from that. So it really depends. If you want to think of it as a mature policy to kind of wrap your mind around, this could be one of my policies, for example, that's 7 years old. That's totally fine.
Okay.
It could, but it doesn't have to be necessarily.
Yeah. You want to balance it from, there's the eager investor syndrome that we talk about. where people
FOMO.
say, "Oh, I want to get all this cash into a policy so that I can immediately use it," which may or may not be a good thing. Like some people, like say real estate investors, it makes a lot of sense for real estate investors to funnel. They're usually cash rich or cash poor. They just did a deal, they just sold a deal, they're cash rich. Let's get that into a policy, and now we've got that cash available when the next good deal comes along.
No, they don't have time for that, Dave. They don't have time for that. Just so, just no, we're so busy.
Yeah, I give real estate investors a hard time because of some people I've encountered, but then we get people like Rajiv, who is a real estate investor, and I gave you a hard time on the first call we had, or told you what my
I fit the
experience is.
profile for sure. Hey, so one question on here I do have, the 100K that you're taking a loan out on policy A, that's feeding into the note, correct?
Correct.
Correct.
And at 2,100 a month return, that's about a 30% annualized return, roughly. Is that what?
But should be 20.
Well, it's principal and interest.
Right.
It's an amortized return.
Cash on
So
cash is 20% ish. Right. Let me see here.
But just to make sure I understand the example, so you're saying you take 100K out of your policy A, you go invest in the note,
Yep.
and the note is returning you 2,100 a month.
Yes, in principal and interest payment. The first payment is $791 in interest and $1,308 in principal.
Okay, so when you say, and maybe this is just my lack of knowledge on how that works exactly. So out of that 100K, they're returning you part of that 100K capital,
Yes.
and then a amount above and beyond that, which is your profit.
Yeah, so at the end of 5 years, you will have all of your money back. So it's not going to be at the end of 5 years, you get your 100K back. You've got it back over the 5-year period.
Got it. Okay, thank
Yeah.
you.
That's why you don't view this as something that, oh, that $2,100, that's cash flow. I can just go spend on my lifestyle. No, because that includes the principal amount you put into it. So be careful. This is why this one is not for everybody, because you can't look at this as just free and clear cash flow that you can go spend.
Right. It's not interest only.
Right.
I'll say this. We were talking about this earlier, Dave, but this is done with purpose and intent. The purpose of this strategy, well, in this case, was to fund another policy, but it's really to create a snowball effect of cash flow, where it's slow at first, and then over time we keep participating in a note and adding to our cash flow, paying back loans faster, and every time we do a note, we're able to pay back that loan faster and faster and faster. Right? That's kind of the purpose of this. Is a great use of it to pay new premium? Maybe. It could be used to pay your electric bill or your utilities or your car payment or whatever, right? But the purpose is to not spend it. Like if you're just spending it on, well, I'm not going to say that, but if you're just spending it, that's not what you want to do. That would not be a
strategic.
good fit for this. This is very strategic, done with purpose and intent. Yeah.
All right. I just ran out of space on the free version of that program, so
Of course
I can't
he has the
draw
free
anymore.
version.
I just need to go delete some stuff in that one. I take a lot of notes on there. I like it.
Yeah. Hey, just bringing it back to Nelson, right? Page 69. He goes over an example of kind of investment outside of a policy, just using cash, and an investment using cash value from a policy, and showing the comparing and contrasting of how it looks completely different. Because not only did you get the growth from the investment, right? You're getting growth on the policy every year. You're just paying your premium, and your policy's growing, right? So you're kind of able to make money in various ways when you are funneling it through a system of a policy or a system of policies. That's important to remember.
Yep. So the only other thing I might add to this discussion is don't raid your cash value and use all of it. We're big proponents of keeping your emergency savings as part of your available cash value.
Correct.
So this is a number that once you get above that number, where I got a certain number, I never go below that. But anything above that, now it's available for opportunities. And this is one of those opportunities. I think the minimum for this is $2,500 to get involved. And, which isn't going to be a huge payment coming your way, but it's something that could start the snowball. That's $52 a month. But you add that to whatever other cash flow you have to pay back that loan as quick as possible, and boom, you got to pay back, and you just recycle the thing again.
Yeah, it works with any amount of money, right?
It does. Yeah.
It's you start where it's kind of like your premium. Start where you're at.
Hey, Dave, how do you think about balancing how much of your cash value is used for the dual asset strategy so you kind of optimize most efficient use of money versus what you just said, having an emergency fund in there as well for future opportunities?
Yeah, I would say don't feel just because you have cash value that you need to go put it to work somewhere outside of your policy. But if the right opportunity comes along that fits your, say, investor DNA or what you're really good at or what you understand really well, then why wouldn't you? You're going to be better off taking cash value loans to do that investment or fund that opportunity than you would be if you were saving that money in a bank account and putting that towards the opportunity.
Sure. Yeah, and getting back to eager investor, I've always found like I've done going back 5 years, I'm thinking through all the private money loans I've done, all the real estate syndication investing that I've done, which I'll never do again. And there was always, it never failed, right? I deployed some capital and then a far better, far safer, more profitable opportunity came my way, and I wasn't able to do it. And I was just like, now, if you can't wait forever, obviously. If you think the deal is good for you at that moment, if it's your risk tolerance, execute. But the more capital you accumulate, the better the deals can be.
Yeah,
for sure.
And there are plenty. I mean, we preach about this all the time. The whole you got to take big risk for big reward is the dumbest thing I've ever heard. And
yeah,
it's the quickest way to lose money. I can tell you from firsthand experience, and probably many other people can too. One of them I'm staring at right now. Yep.
Fool me thrice.
Fool me once, shame on you. Fool me twice, you ain't gonna fool me twice. Except we were fooled more than twice.
So stupid.
Yeah, so there are places. I mean, I'd much rather take an extremely low risk opportunity at a single digit return than a high risk opportunity at 25% return, because I don't care about the return. As long as it's more than what I'm paying to borrow that, than my cost of capital, then as long as there's extremely low risk, it's a very positive return because I'm using somebody else's money to fund it.
That's right. And, just by the nature of properly executing Nelson's intent, you're going to enhance your returns just by becoming your own banker and financing the needs of life through a system of life insurance contracts. And he says 34.5%, is, of every disposable dollar is lost to interest to somebody else's bank over your lifetime, average man or woman. So just by practicing this properly and running as much of your capital through a system of policies, you're automatically going to enhance the returns you otherwise never would have realized ever by not practicing the concept. So that's why I always tell people early on, like, don't think real estate investors they want to put all the capital in, take it all back out, and that might work, and that's totally fine if that fits what they want to do. That's great, but that's not for everybody. Not everyone's a real estate guy or gal, and you need to kind of tailor this to what you need to do and what your needs are. So just remember that you are going to be more efficient with your money just by practicing the concept.
Mm-hmm.
Okay, so a question to bring us all around full circle to the beginning of the hour. So these notes are a commercial investment note loan that this pool of investors are providing, what is the how long has this been going on for you guys? And for the foreseeable future, because like right now you're saying this is basically a 5-year note window. How many 5-year notes have you done in the past, and how many are you expecting in the future?
Yeah, well, the structure's been around for
Longer, far longer than that.
over 5 years. I mean, I've been a part of this structure for over 5 years, but it was around
Okay.
another 5 years before me. But the notes, there's usually one every couple months that there's a funding window for it, and there's no foreseeable end to this, so you don't have to be in a rush. And again, I'm not promoting that you should go do this one. I'm just saying this was a good opportunity that I participate in. Paul participates in. I know a lot of our clients do, but it's very safe. From the everything I've done, I haven't found something safer. But if you want to learn more, if you guys want to learn more about it, I can send you information on there's like weekly presentations on this one if you want to learn more about it.
Yeah, and was that Chet?
Yeah.
Yep, that's me.
Yeah, I would say outside of this, in my private lending career since 2016, I think I've done one note that was 60 months outside of this, to a private company. Actually, I started the company with capital that I raised, and Dave was in participating, and
I'm still in that one.
and he's still in it. I've been paid out, but
I think I still got another year of that one.
yeah, at least. But that was a very great opportunity. It was collateralized. It was a great business and a great guy. But it was a long duration interest only note, so not amortized. So it was interest only, and we structured the terms ourselves and made it very favorable for him, the borrower, and for us, the lenders. So, but generally speaking, most of the stuff I've done has been short duration stuff. Outside of real estate, it's been 6-month notes, 12-month notes, in the private lending space.
And then just to tie it into the life insurance policy notes, we're just looking at that delta difference between if it's the policy note interest is 6 to 7% and these are gaining 9 to 10%, is your profit is that 3% delta.
You could look at it, and most people look at it like that, but it's actually a lot more than that.
Go to page 69 in Nelson's book.
If you think about it, Chet, your only cost out of your own pocket to this entire investment is the interest that you pay the insurance company. That's your only cost. So if you take the profit that you earn and compare that to the interest that you paid, is actually it's a lot more than 3%.
Okay.
Yep. And then you can enhance your return in anything you do outside of whether it's these notes or something else, whether it's a real estate property you buy, it doesn't matter. But by directing other cash flows against your loan, your policy loan, you're effectively enhancing that return anyway, right? And then don't forget, you're paying your premium, your policy's growing as well. So like Dave said, calculate what interest you actually did pay over that maybe first 12 months versus what you received. It's quite good.
Could you talk a little bit about how the policy grows? I'm still a little bit unclear about that.
Sure. Well, there's two ways in which the policy can grow, right? Obviously, this assumes you're paying your premium, which is your side of the contract is to fund the policy, right? So that goes without saying. So there's contractual growth of the policy if you've seen a life insurance illustration or if you've read your contract, which the illustration is also a part of, you look at the left side, there's something that says guaranteed, right? That is the guaranteed contractual growth that the company literally is guaranteeing that contract will look like. right? Year over year over year, and those years represent end of year values. All right, so it's not like you hear out on YouTube and other people saying, "Oh, let's get this interest rate and all that." That's all noise to me. You can calculate the internal rate of return, no question, on your policy by just doing some simple math. The other way your policy grows is through the non-guaranteed annual dividend, right? So that also is adding, I suppose you could look at it as additional interest to the policy, just in a non-guaranteed but very reliable manner. One of the companies that we primarily use, and if you're our client, you probably know, has paid a dividend every year since 1905, right? So that's the two ways the policies grow, right? Guaranteed and then non-guaranteed dividends. There, again, you can calculate the internal rate of return, but it's not going to be static either, because on the non-guaranteed side, dividend rates go up based on interest rates out in the marketplace, right? Right now, interest rates are higher than they had been over, probably the last 10 years. Interest rates have been extremely low, so dividends have come up, right? But it's only a matter of time before the Fed messes up the economy again, and then interest rates will go down. And so it's the opposite. Everyone's like, "Oh, I want interest rates to go down." I think the complete opposite. I wish they had jacked them up to like 10%.
And then are you able to say on the guaranteed portion, is there kind of a ballpark, 3, 4, 5%, 7, 8, 9%? How does
No.
that?
No. I'll be honest with you, Rajiv. I don't even look at that, so I have no idea what number to tell you. I would hesitate to throw out a number. But I would say this is not about interest rates or rates of return. Again, if you read, I don't know, maybe page 3 or 4 of this book, he says that this is about the banking function and controlling the function of banking in your life. Interest rates are going to go up. Interest rates are going to go down. You and I can't control that, but the business of banking goes on no matter what. That's what this is about. And a lot of people have trouble understanding what we're talking about when we say banking, but that is what the infinite banking concept is about. I could care less what the internal rate of return of my policy is. Don't care. I care about what I'm earning outside of it, though. So that next real estate deal, that next note, that next whatever, that's what I care about. This is just a storage facility for my money. Now, it's going to outcompete over time a savings account or a CD. And it's not taxed. So if you want to make an apples to apples comparison, savings CDs versus dividend paying whole life, that's the comparison I would make. So somewhere in that range.
That's helpful. Thank you.
Yeah, you bet.
Like Paul said, I don't care about the rates of return inside my policy because I'm getting multiple rates of return outside my policy.
Yep. Again, go back to page 69, Becoming Your Own Banker, 5th edition.
So, Chet, back to your question. I don't want to get in too much in the details on this, but I did create like a little spreadsheet and did some math myself before this to show like an option 1 where you're doing a $10,000 note. You're using that $210 to repay your loan. And you're not putting any other additional cash flow back into your loan, right? You're just using that $210 to repay it until it's all gone. And that's covering the interest on your loan as well. If you did that, at the end of 60 months, that $10,000 has actually paid you out $12,600. So that's a $2,600 gross profit, right? Well, the interest you've paid over that time is $1,400. So your only cost for that investment was $1,400. So basically, you took $1,400 and turned that into $2,600 over a 5-year period. The rate of return on that is 17% per year. Simple interest. Compounded, that's like getting a 13% compounded return every year.
Right.
I
just checked his numbers. He's right.
That's what it is. It's not 3% like you were thinking, which is what most people think. 99% of people would say, yes, you're earning 3%. You're actually earning 17% every single year.
Right. And this is how the banking business works.
Yep.
The banks pay you nothing, and then they lend you your own money back at 8%.
Yeah.
So it's, and they do it
Okay.
over and
Thank you
over
for that
and over.
explanation. It's still, if I'm still in elementary school on this, that might be a high school level of concept. It makes sense, but I'm not grasping it yet to take the ACTs and the SATs.
Yeah. Yeah. Again, I only say that to think that, it's not what we think we know, or it's not what we don't know. It's what we think we know that just ain't so, that trips us up. And we think when we look at the math that we're earning 3%, a 3% spread on that. But the fact is that's inaccurate, highly inaccurate, because you're earning, over 5 times more than that. Because you got to think of it, when you do this, you're borrowing the insurance company's money. The only money out of your pocket, period, is the interest that you owe the insurance company on that loan. So you didn't put $10,000 into this. You put $1,400 into it in the interest you paid out over 5 years.
Okay.
But you earned $2,600. So again, I wasn't planning on getting into those details, but I think it's pretty important to point that out.
Yep. Again, go to page 69, Becoming Your Own Banker. I think it's an overlooked page. I know I overlooked it. Mainly because I think the first time I read it, I was like, what is he talking about? But
that's what I thought.
You'll get it after this discussion.
Every page.
Yeah.
Yeah,
it does.
Real quick, if I could, just reading comments on Wealth Warehouse stuff often, and just IBC stuff in general. 99% of people are so focused on the front end interest rate, they can't even move past the holistic picture of everything else that's working across their whole entire lives and their banking system right now, like where their money's going first, loan origination, like you guys talk about often, stuff like that. It's like they just look at the deal. Okay, I take money, put it here, it comes back, return maybe, right? But most of these plans, as we know, they're like, oh, you're doing that, but you could be getting some arbitrary made up number return over here. But it's a could or a should or an if this happens, right? So they're so caught up on percentages on the front end. Whereas when we get into IBC, it's you start to look at different aspects of your whole system, right? How money flows to and from all these things.
Yeah, it's a great point. Great point. It's they focus on the scene because it's easy and it's obvious. Like, oh, the policy loan rate is X, the internal rate of return of the policy is X. But the unseen advantages. I think we have an episode titled that or something.
Yes.
There's infinite advantages to practice. I often say this on the podcast, right? If I had a twin, right, same investment portfolio, but I'm doing IBC. My twin is not. He's going to be ahead early on. But over the long term, I'll run away.
I would create an analogy to think of somebody in your life. Like if I think of Paul, like the unseen advantages of Paul and I meeting and creating a personal relationship, I'm seeing the unseen advantage right now. Everybody on this call is probably only connected to me because I first met Paul, and Paul and I started talking and working together. Like all the advantages that have come from that is far greater than just what Paul and I have encountered just together, right? It's everything that came with that. And that's stuff you just won't see. You don't know what you're missing out on because you can't see it. It's impossible to know.
Yep.
All right.
This is a good one, guys. Really appreciate the participation and great questions and great discussion. And
Yeah.
Read this book again.
Read that book. And if you guys have questions, you want to dive further into this, get a hold of me or Paul. You guys should have our contact info. And, if you're looking to start it, or you think you might be at the point of being able to start a new policy and you have cash value available, let's game plan that and see if maybe this is an approach you would want to take in order to make that happen. But it's just one way to do it of many ways. So hope you all enjoyed that. And yeah, thanks for spending your Saturday morning with us. We'll see you guys again next month, if not before, I'm sure.
Thank you, guys.
Thank you,
Thank you.
David. That was great.
Thank you.
All right, great. Until next time, control
Thanks,
your
y'all.
capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.